Last week, the bond market had just a bit of a moment. If you watched financial television, you probably saw people getting very concerned about treasury yields, about borrowing costs in the Federal Reserve, and the future of U.S. government financing. And if you're a normal person, your response was probably, okay, what does that mean and why should I care? Bonds aren't exactly exciting. There aren't dramatic images, no stock tickers plummeting 1,000 points in a single day. But something important happened last week underneath the whole financial system. The interest rate on 30-year U.S. government debt climbed to levels not seen since 2007. The Treasury Department, trying to calm things down, failed, tried again, and then failed again. And investors nervous about lending money to Washington are demanding higher and higher interest rates. Here's why that matters to you. When investors become nervous about lending to the U.S. government, those higher borrowing costs don't stay in Washington. They spread. Eventually, they mean more expensive mortgages, car loans, more expensive credit cards. A problem in the bond market becomes a problem in your household budget. I'm Keith Conrad, and this is Sidequests. In this episode, the bond market panic, what's actually happening, why the government is in such a precarious financial position, and how a crisis on Wall Street can eventually reach Main Street. First, let's understand what a bond actually is. The U.S. federal government has a problem. It spends more money than it receives. Way more. Year after year, Congress passes budgets that spend more than the government collects in tax revenue. That creates deficits, shortfalls, and a need to borrow money. So the Treasury Department borrows. It issues debt. Lots of it. Here's how it works. You give the federal government money, let's say $10,000. The government gives you an IOU, a treasury bond, a piece of paper that says, we promise to pay you back this money on this date, and while you're waiting for your money back, we'll pay you interest. That's a bond. It's a loan to the federal government. The United States is the world's largest borrower. The treasury market is the world's largest lending operation. And what happens there influences borrowing costs throughout the entire economy. Now, if you're going to lend the U.S. government money for 30 years, you're going to want something in return. That's the yield. The yield is essentially the interest rate, the price the government pays to borrow. Think of it this way. When you want a mortgage from a bank, the bank considers you and your financial situation and decides what interest rate to charge you. It's the same with the U.S. government. Investors decide what interest rates they want to charge the government to borrow money. When investors feel confident the U.S. is a safe bet that it will pay them back, they'll accept lower interest rates. But when investors become nervous and they worry about the government's financial health, when they see rising debt and rising deficits, they demand higher interest rates. They essentially say, I'll still lend you the money, but you're going to have to pay me considerably more to do it. Last week, that's exactly what happened. Investors became nervous, and they demanded higher yields. The 30-year Treasury yield hit 5.34%. That's the highest it's been since 2007. To put that in perspective, that's like Uncle Sam suddenly having to pay 5.34% interest on a 30-year mortgage. That's a significant increase from just a few weeks earlier, and it signals that investors are getting a little worried. But before we talk about what happened last week, we need to talk about something really big, something that most of Congress seems to have decided to ignore. Last week, the U.S. national debt hit $40 trillion. Let's put that in perspective because that number is almost impossible for the human brain to comprehend. I mean, 1 billion is a pretty tough number to get your noggin around, but 1 trillion is actually 1,000 billions. If you earned $1 million per day, $365 million per year, it would take you 109,589 years to earn $40 trillion. It's important to dream big, but you're probably not going to do that. If the entire world economy, all production, all commerce, all goods and services just stopped and we devoted every penny of global GDP to paying off the US debt, it would take us years to pay it off. The United States created more debt in the 15 years since 2009 than it had accumulated in the entire history of the country before that. And Congress has done nothing. Here's what's remarkable about that milestone. Congress knew it was coming, knew the debt was going to reach $40 trillion, knew it was creating unsustainable long-term obligations, and Congress did nothing. No serious debt reduction plan, no spending controls, no revenue increases, just more of the same. Spending more than it collects, borrowing the difference, accumulating debt. Members of Congress talked about debt reduction, made it part of their political rhetoric, then they voted for budgets that increased spending and increased deficits. So the debt hit $40 trillion and it barely made a ripple in things. If this were happening in a private company, if the CEO let the company accumulate $40 trillion in debt while the board of directors did nothing, there would be accountability and changes, but Congress just continued, and that's what's creating the anxiety in the bond market. So last week, nervous investors didn't just wake up worried for no reason. There are several reasons they're demanding higher interest rates. First, the debt itself, the $40 trillion, that's an enormous amount of money for investors to have to absorb. The government keeps issuing new treasury bonds, keeps borrowing, and investors have to keep buying. But how much are they willing to hold? How much risk are they willing to take on? The second part is inflation. Persistent inflation in the U.S. economy. If you're a bond investor, inflation is your enemy. You lend dollars today, you get paid back in dollars in the future. But if those dollars are worth less because of inflation, well, then you've lost money. Investors are concerned about inflation continuing, so they demand higher interest rates as compensation for that risk. And the third is energy prices, one of the big drivers of inflation. Oil is trading at around $90 per barrel. Higher energy prices can push inflation higher, which makes investors even more nervous. Put it together, more debt, more persistent inflation, higher energy prices, and investors began demanding greater compensation for lending money to the government over long periods of time. Yields rise. Last week, the Treasury Department realized they had a bit of a problem. Yields were rising, the bond market was showing signs of stress, investors were getting nervous. So the Treasury tried something: long bond buybacks. Essentially, the government said, we're going to buy back some of our own debt. We're going to take some of the bonds out of circulation. That should help the market function more smoothly. The Treasury announced it would double its long bond buybacks. Instead of roughly $2 billion, at least $4 billion. Instead of roughly $2 billion, at least $4 billion. The immediate reaction was that it worked. For about a day. 30-year yields fell roughly 10 basis points. The stock market jumped. Everything looked better. And then about 22 hours later, the improvement completely disappeared. The 30-year yield climbed back up over 5.2%. Stocks fell, and the temporary relief evaporated. Treasury Secretary Scott Bessent went on CNBC and suggested the government had additional tools available. Maybe buybacks could become larger. That provided another temporary. Yields eased for a while, and then they began climbing again. Here's the crucial distinction. Treasury buybacks can improve the functioning of the bond market. They can make it easier for investors to trade. They can reduce some of the technical stress in the market. But they don't make the $40 trillion national debt disappear. It's like paying your credit card minimum while ignoring the underlying balance. You're addressing the liquidity problem, but the fundamental problem, the excessive debt, is still there. The underlying concern driving higher yields isn't just it's difficult to buy and sell bonds. It's increasingly, we want more compensation for holding U.S. government debt. That's a much harder problem for Washington to fix with short-term interventions, because the solution requires addressing the actual debt problem, controlling spending, raising revenue, making hard choices about what we're going to do in the future, and Congress simply isn't interested in doing that. Okay, so bond yields are rising. Treasury officials are panicking, so why should you care? because Treasury rates don't just stay in the Treasury market. U.S. government bonds are benchmarks for borrowing throughout the entire economy. When long-term Treasury yields rise, that creates upward pressure on the other interest rates, including mortgages. When Treasury rates rise, mortgage rates also typically rise. Car loans, same deal as mortgages, but on a slightly smaller scale. Business loans, same deal. Higher yields means higher borrowing costs. Credit cards, they're often tied to Treasury yields. So a problem in the bond market becomes a problem for your household budget. Higher mortgage payments, more expensive car loans, credit cards with higher interest rates. And there's another consequence. When Treasury yields rise, the U.S. government has to pay more to borrow. That means the government's interest expenses increase. Interest expense is the fastest growing part of the federal government. Not entitlements, not defense spending, interest rates. Already the government spends hundreds of billions of dollars per year just on interest. Higher yields means higher interest payments, which requires more borrowing, which increases the debt further, which potentially increases investor concerns, which pushes yields higher, which means higher interest payments. It's a feedback loop, and it can spiral completely out of control. So last week, the bond market had a moment. The 30-year Treasury yield climbed to levels not seen since 2007. Investors grew nervous. The Treasury Department tried and failed to calm things down. And the underlying problem, $40 trillion in national debt, climbing with no serious plan to address it, remains. Congress created the problem, and Congress continues creating it. They're doing nothing about it. And the market is noticing. Investors are noticing. They're demanding higher interest rates to compensate for the risk. The bond market doesn't usually produce dramatic headlines, but in some ways, it's more important than the stock market, because it's where the price of money gets established. It's where investors decide what they'll charge the government to borrow. And when the world's largest borrower starts paying substantially more money, those higher borrowing costs spread throughout the entire financial system into mortgages, car loans, credit cards. What happens on a trading screen last week becomes your household budget today. I'm Keith Conrad. Thanks for listening to Sidequests.